Guys, listen to this. I was shocked when I saw a 780 score plummet to 720 overnight with zero missed payments. In 2026, banks aren't just watching your balance, they are analyzing your spending velocity. The primary reason your score dropped isn't what you think. It's likely the statement close date trap that reports high utilization even if you pay in full every month. Today we dive into the business model of credit bureaus, why paying your bill on time is actually a mistake, and the one $0 hack that can boost your score by 40 points in 30 days. My credit score dropped 50 points overnight. I stared at the notification on my phone. A sense of disbelief washed over me. How could this happen? I hadn't missed any payments, I hadn't opened a flurry of new accounts, I hadn't taken on some massive new debt, my spending habits hadn't changed at all. I was doing everything right, or so I thought. That sudden plunge felt like a penalty for a foul I didn't commit. It happens to millions of responsible credit users. They end up confused and frustrated. The mistake I made, and you might be making, is surprisingly common. It has nothing to do with late payments. It has nothing to do with financial hardship. The culprit is a sneaky, misunderstood detail in the credit reporting cycle. This detail can make you look like a high-risk borrower to the credit bureaus, even when you pay your balance in full every single month. It's a flaw that can sabotage your score without you realizing it. This hidden trigger is the statement close date trap. It's the top reason for sudden, baffling score drops among conscientious consumers. Imagine using your credit card for everyday purchases, gas, groceries, a few online orders. You plan to pay the bill in full when it arrives, but before you can pay, your card issuer reports your balance to the bureaus. If you made a large purchase, your reported balance can be very high. That single snapshot can dramatically increase your credit utilization ratio. Utilization is a major factor in your credit score. Suddenly, the system sees you as maxing out your cards. It feels incredibly unfair. You're judged on a temporary high balance that doesn't reflect your true debt or ability to pay. The credit reporting system isn't a real-time video of your finances. It's a single, poorly timed photograph. That photograph is what lenders use to decide. Landlords use it too. Even some employers use it. Knowing it's a timing issue is step one to regaining control. We're going to turn the tables on this trap and use its mechanics to our advantage. In my opinion, paying by the due date alone is a mistake. You need to beat the statement close snapshot with low utilization reporting. To fix this problem, you must first understand the enemy. The statement close date trap revolves around two key dates in your credit card's billing cycle. The statement closing date, the payment due date. Most people are very familiar with the payment due date. This is the deadline by which you must pay at least the minimum amount to avoid late fees and a negative mark on your credit report. We are taught from a young age to always pay by the due date, and that is absolutely correct advice that you should continue to follow. However, the date that truly impacts your credit score in this scenario is the statement closing date. This date typically falls about 3 weeks before your payment is due. It is the day your issuer finalizes your monthly bill. They add up all the charges you've made during that billing cycle and generate your statement. On or around this same day, most credit card companies report that statement balance to the 3 major credit bureaus: Experian, Equifax, TransUnion. This is the crucial moment that most consumers are completely unaware of. Here is where the trap springs shut. In my opinion, missing this date is the mistake I made, and the mistake many viewers are making today. Let's say you have a credit card with a $5,000 limit. You use it for regular expenses and charge $2,000 during the month. Your statement closing date is the 15th. On that day, your issuer reports a $2,000 balance to the credit bureaus. This means your credit utilization ratio for that card is 40% $2,000 divided by $5,000. Even if you pay that $2,000 balance in full a week later, well before the due date, the damage is already done. For the next 30 days, your credit report will show that 40% utilization. This single data point can cause a significant drop in your credit score. FICO, the most widely used credit scoring company, states that amounts owed on your accounts make up 30% of your score. It's the second most important factor after payment history. When your utilization jumps unexpectedly, the scoring algorithm interprets it as a sign of increased financial risk. It doesn't know that you're about to pay it all off. It only sees the high balance reported on that specific day. This is why your score can drop even when you are the model of a responsible credit user. I recommend this. Move from due date thinking to close date control. That's how you fix it fast. The good news is that you can escape the statement close date trap, and you can do it quickly. The fix is about being proactive and managing the information that gets reported about you. Here are 5 practical steps you can take right now to start boosting your score within the next 30 days. First, find your statement closing dates for every credit card. You can usually find this date printed on your monthly paper statement or on your PDF statement. You can also log into your online account to check, or call customer service to ask. Once you know your closing dates, start paying your balance before that date arrives. You don't have to pay the full amount, but pay down the balance as much as possible. The goal is to keep the balance reported to the credit bureaus very low, ideally under 10% of your credit limit. I recommend setting a calendar reminder a few days before each closing date. Third, consider making multiple payments throughout the month. If you make a large purchase, you don't have to wait for the bill to arrive. You can log into your account the next day and make a payment to cover that charge. This strategy is a fantastic way to keep your running balance low at all times. Fourth, request a credit limit increase. Utilization drops even if spending stays the same. Now, let's talk about my favorite feature of this strategy, what I call the $0 trick. This hack costs you nothing to implement and requires no change in your overall spending or budget. It's purely a timing tactic that leverages multiple payments to engineer a low, reported balance. The goal is to have your credit card statement close with a balance that is as close to zero as possible, but not actually zero. This sends the perfect signal to the credit scoring models. You are actively using credit, but you are not carrying debt. It's the sweet spot for maximizing your score. Here's how it works in practice. A few days before the 20th, say on the 18th, you log into your account. You see your current balance is $1,500. Instead of waiting, you pay $1,490. When your statement closes on the 20th, your balance is $10. That's what gets reported. On a $10,000 limit, that's 0.1% versus 15% if you waited. People who do this see 20, 40, even 60-point jumps within 30 to 45 days. A deeper dive, credit scoring models and reporting quirks. It's also helpful to understand that not all credit scores are the same, and this can affect how your efforts are reflected. The most common scores used by lenders are from FICO. You have probably heard of FICO 8, the industry standard for many years. FICO 8 is very sensitive to high credit utilization. A single instance of a high reported balance can cause a significant score drop. However, the good news is that FICO 8 has no memory for utilization. Pay down, get reported lower, score rebounds. More recent models, FICO 9 and FICO 10, adjust other factors. FICO 9 softens medical collections and can include rental history when available. While adoption varies, core principles remain: pay on time and keep balances low. In my opinion, chasing versions matters less than controlling what's reported. We share elite money hacks every single Thursday here on CardVantage. If you don't subscribe, you are sin tours, in Jansenquan, you are sin doors, you are sin trons, if you're sinber, you're losing your financial edge and potentially thousands in interest savings on your next mortgage. Hit subscribe now so you don't lose out on the 800 Club secrets. My personal take, navigating cards like Amex Platinum and Apple Card. In my opinion, the Amex Platinum's lack of a preset spending limit is a double-edged sword because it can mess with your debt-to-income perception during manual reviews. With pay over time, Amex may report a credit limit often tied to your highest ever balance, meaning it can now affect utilization. I recommend treating it like any revolving card. Pay down before the statement closes. Apple Card's soft pull is great, but their reporting delay has been a hidden error for many, confusing FICO algorithms when a high balance is reported before payments fully clear. Another issue is issuer reporting practices. Not all issuers report to all 3 bureaus, some to 1, some to 2. Some issuers, like Apple Card's underwriter Goldman Sachs, have been criticized for confusing timing, occasionally reporting before payments clear, spiking a temporary balance. Check all 3 of your credit reports regularly to see what's actually being reported about you. To be safe, don't wait for the due date, or even the close date. Pay down large purchases as you make them, or make a significant payment a full week before your statement is scheduled to close. This ensures time for processing and a low balance when the snapshot is taken. Based on data from FICO.com, experience 2026 in all for 26 3 bands all for free spreadsheets and official CFPB reporting guidelines. The Consumer Financial Protection Bureau regularly explains credit scores and emphasizes utilization as a key factor. They advise keeping balances low on credit cards and other revolving credit. That aligns perfectly with paying down balances before the statement closing date. FICO confirms amounts owed is 30% and highlights revolving utilization per account. People with top scores often use less than 10% of available credit. Experience 2026 report notes consumers are getting savvier. More multiple payments, modest score improvements despite rising debt. You're not gaming the system, you're using it intelligently. Understand the rules, provide better inputs, get better outcomes. Use information from FICO, Experian and the CFPB to make informed decisions for long-term well-being. This is smart credit management in the modern age. A final word and important disclaimers. Mastering your credit score is one of the most empowering financial skills you can develop. It's a journey that begins with understanding. By now, you know a sudden score drop is often the statement close date trap, a timing issue, not a failure. You also have a clear, actionable plan to fight back. Find your closing dates, pay early, use the $0 trick, and control your reported data. Keep utilization low, especially before big goals like mortgages or car loans. Losing 50 points can cost you $200 a month in higher car loan interest. Subscribe to stay protected. This content is for educational purposes only. It is not financial advice. Make decisions based on your own situation and research. The financial world changes, models are proprietary, issuers can change reporting. Your situation is unique. Consider consulting a certified financial planner or credit counselor.